Barry, always great to get your insight on what's happening in the markets. Walk me through the difference between what's happening with sentiment, which is quite clearly rocked by this trade conversation, and what you see in the fundamentals at the moment.
Yeah, when you think about trade in the United States and abroad, the administration's policies make a lot of sense in the long term. Now, in the short-term economics, the economists make a good case that they don't make sense. But when you think about the long term, there's a need for better trade balancing, and getting from A to C is going to require going through some turbulence in B, and that's what we're dealing with on the trade front. And when you look at the sentiment as it affects the market, the PE ratio is still a little bit too high. And when you've got a stronger dollar, earnings come under some pressure, and I think that plus trade is going to affect the middle months of this summer.
So, Barry, let's walk through that and your call for that risk of a 5% correction on the S&P 500, at least in the near term and through the summer. Earnings estimates have actually been increasing. Traditionally, as we all know, they usually go the other way. Analysts look at their projections and then they revise them lower as the year progresses. That hasn't happened through 2018. How supportive is that story, that earnings optimism for the equity market here?
Yeah, Jonathan, I mean, if you look at it, the earnings estimates are going to be strong because we cut the corporate tax rate to 21%. So we're looking at 153 on a Bloomberg operating number for the S&P 500. That's up about 23% year over year. But when you consider the fact that real rates just went positive, this is the rate minus inflation using core PCE, real rates just went positive for the first time in 10 years. You're starting to see PE compression offsetting some of the earnings growth, and that causes the S&P to go sideways for the most part this year. We actually think the year ends roughly where it began, but with a dip here in the third quarter into maybe October.
So, Barry, I want to get your thoughts on how we're set up for earnings season. It's just around the corner, and the psychology that people picked up on pretty quickly in the last reporting season was that this could be as good as it gets. We all remember the Caterpillar call. People ran away with that idea. What's the psychology going into earnings season over the next couple of months?
Yeah. First quarter earnings were obviously very stellar. You had your first bit of the tax rate cut. You'll see, though, now, I think, if the dollar, using the broad trade-weighted dollar, which we look at, and it's a little over half of that is emerging market currencies, which are under pressure. As you know, every time the Fed begins down the highway of normalization, the emerging markets become roadkill for the Fed cycle. And so what you're seeing is some upward pressure in the dollar that's going to affect the earnings estimates as you hit second quarter, particularly in the back half, and you'll see guidance for some companies brought down. There is still this residual trade tension, and you'll see some, I think you're going to see some unit labor cost increases, although we'll see what productivity does. And when you have labor cost per unit of output going up, you have pressure on margins. And so you need some pretty heroic margins to hit these strong growth numbers that some of the analysts have in the back half. And I don't really think that's going to be as easy to achieve as some expect.